Hi, my name is Gary Mishuris. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. Previously, we finished talking about risk, and what we meant by risk is the probability and magnitude of permanent capital loss. Now, in this last part of the owner's manual, I'm going to talk about how do we construct a portfolio in order to manage risk. Because at the end of the day, that's what portfolio construction is about. If you didn't think about risk, what would you do? Well, you would take the best investment you have, or the one that promises the highest expected rate of return, and you would put all your money in that. So why don't you? Well, the reason you don't is you can be wrong, and if you're wrong, you're going to permanently lose your capital, and that's going to be potentially unpleasant. So there's this tension here between making sure you don't lose capital permanently and not over-diversifying such that you don't reduce the expected return of your portfolio too much. And that's the tension where portfolio management really comes in. So let's think about it this way. You want to make sure that it's your process, not any one decision individually, but the process that's generating your long-term results. You want to make sure that if you have a rigorous disciplined process and you're following it, like I am, you want to let that shine over time. And what you don't want to have happen is you don't want one decision all of a sudden, erasing years of work because you got overconfident and you made a really large investment and you were wrong, and all those other good insights that you had essentially got canceled out. And by the way, there are a number of well-known value investors, I won't mention them by name, who more or less ended their careers that way. They had a long record, 10, 15 years of great results, and they made one big decision. They got overconfident and they kind of lost it all. Maybe they didn't lose all their money, but they certainly erased all the value added versus the opportunity cost that they've added for their clients over those many years. So we want to be humble enough to understand that we're going to be wrong, and we want to expect that and manage for that. So the idea here, and this is the key idea, so I'm going to say it twice to highlight it, is that you want to be able to make a mistake on any one decision, not just one investment, but any one decision, and not lose so much of the portfolio that the rest of the portfolio can't overcome in a short period of time, such as a year. So again, the idea is you don't want to have any one decision lose more money for the portfolio that the rest cannot overcome in a year. In practice, given reasonable rates of return, what that means for me is that I don't want to have more than 10% at risk of permanent capital loss in any one decision, because I think, let's say the worst happens and you're going to lose 10% on that decision. That's a bad outcome. That's not a good thing to happen. But the 90 can go back to up to 100. That would be about 11% rate of return. That's doable. However, let's say you lose 20% on one decision. Well, for 80 to go to 100, now you need 25% return. That's very, very hard, if not impossible, on a reasonable basis in a one-year period. So that's the kind of the target. That's the litmus test for am I taking too much or too little risk, is to make sure no one decision exceeds 10% potential loss at the portfolio level. What does that mean in practice? It could be one investment. It could be a completely independent investment over anything else, and you want to make sure that what I call portfolio at risk. And when I say portfolio at risk, I'm multiplying the downside to the worst case at times the position size. So I want to make sure the portfolio at risk is not more than 10% any time. So let's use an actual example. Let's say you valued this pen in a range, and the downside to the worst case is 30%. So if you were to make the investment in this pen at 10% position, your portfolio at risk for this investment would be 3%. And that's the downside to the worst case of 30% times the 10% position size. So when I say portfolio at risk on individual investment, that's that multiplying of downside to the worst case times the position size. So at cost, when I initiate a position, I never set the portfolio at risk at greater than 5%. And then at market, meaning at the current market price, as the price changes, I keep it under 10%. And that goes back to the idea of making sure that I don't lose more than 10% on any investment, even if I'm wrong. But it can get more complicated than that. And the reason is, what if you have multiple investments in the portfolio, but their outcomes are related? And that's where it gets tough, where sometimes people use these quantitative systems like BARA to manage risk. And I think there's a problem with garbage in, garbage out. you have to think. There's really no substitute for thinking about businesses fundamentally. And while you're not going to get a precise number, that the risk of your portfolio is 72, you, I think, going to have better insight about the risk than if you have false precision of some system that spits out numbers based on a garbage in, garbage out kind of approach. So you have to think about how are these investments correlated. So if I have this pen and I have this pad and I value them each independently, now I have to think, are there scenarios where these two businesses, and I'm using them as representing a business, are they gonna fail for the same reason? And I'll give you an actual example. At my prior firm, when I managed the value strategy there, the portfolio had two different investments. The first investment was a company called SAB Miller, and what they did is they made beer in various countries around the world. And I owned another company called Qualcomm, and that company dealt in intellectual property related to smartphone technology. So you would, if you're using some kind of a system such as BARA, and you're looking at diversification by industry, say, as a way of measuring diversification, you would look really great because on one hand you have a technology company that's classified in the technology sector. On the other hand, you have a company that makes beer, which would be in the consumer sector. So it looks like clean, no correlation whatsoever, they're independent. But there was a correlation, and that correlation was that in each case, the growth of each business was reliant on the success and growth of the emerging middle class in emerging markets. So, for instance, as people became wealthier in China and India, they bought higher-end beer, giving more business to SAB Miller, and at the same time as they became wealthier, they bought higher-end smartphones or bought smartphones to begin with, and that increased the revenues for Qualcomm. So here there was a correlating factor that if you were wrong, if I were wrong on that bet that the middle class in these countries would continue to grow, then I would be partially wrong on each investment, even though at the surface it seems like they're really completely independent. So you have to, as an art, there are obviously other aspects of each investment in this example which are independent. So it's not that they're perfectly correlated, but there's partial correlation. And in that case, what I do is I make sure that the combined position size doesn't exceed some number like 10% again, in terms of portfolio at risk, not in terms of the size of the position, but in terms of the portfolio at risk for both positions. And again, the idea there is to be humble, to accept the fact, look, you can be wrong, and if you're going to be wrong, now you don't know how much of each investment can sour and how much you can lose for sure. So let's be conservative and size the combined two positions a bit lower and err on that side, maybe give up some upside instead of erring on the other side and losing more capital permanently than we set as our threshold. So that's an example of risk management in practice. The other point is you want to make sure you benefit from your good ideas. So you don't want to have a bunch of small positions for companies where the expected return is very high, the quality is high. So you want to make sure that your best ideas are meaningful and can move the needle for you, subject to the parameters that you use as constraints as far as the risk management that I just talked about. So I use 3 position sizes. Typically it's 5%, 10%, and 15%. And to get from that low end of 5%, which is what a small position is for me, to that upper end of 15, which is what my largest positions are, more and more things have to fall in place. So it's not just cheapness. So for example, I can accept a company with any downside percentage for a small position. And the logic there being that, look, you might have an investment which has 100% downside, meaning you're going to lose everything if you're wrong. But maybe if you're right, you can make 4 or 5 times your money. So the expected return is still quite favorable, even though you could lose everything. On the other hand, I really don't want to have large positions where you could lose everything, because almost by definition, if you have a 15% position and your downside to worst case is 100%, that portfolio at risk would be 15%, and that would be over the threshold of 10. So you want to make sure a couple of things happen. One is I make sure that large positions are only businesses with above average or excellent quality, so I don't allow average quality businesses to become large positions. I also make sure that the downside to worst case for my larger positions is limited, and I limit it to 35% or less, because again, you want to make sure you don't lose a lot of capital in your largest positions. So it's much harder to become a large 15% position, and so I might not have any at a given point in time. But when things line up, when the quality is there, when the downside is limited, and the expected return is high, you do want to have that large position. Now, I know some investors who have 30 or 40 or 50% positions in their portfolio. It's not for me to judge whether that's right for them, but I know that's not right for me. And the reason is, look, I grew up poor. I saw my mother invest most of her savings in mutual funds as we grew up. And I really internalized the lessons from that is, I don't like losing money. And would I take an extra unit of potential return if it meant risking a big loss? The answer is no. Would that potentially keep my expected return lower than it could be? Maybe. But A, I can sleep better at night. And more importantly, I think that's a more prudent, that's a more genuinely conservative way of managing capital that over the long term should produce, if well implemented, a good long-term rate of return.